Hi everyone, you love SCHD, I love SCHD, but here's the uncomfortable truth nobody wants to admit. While SCHD limped through 2025 with barely positive returns, its international twin brother SCHY absolutely crushed it with over 22% gains. I know exactly what you're thinking. Is SCHD dead? Should I dump it for SCHY? Stop right there. That's the wrong question. And it's exactly why most dividend investors are missing the bigger opportunity. Here's what blew my mind when I dug into the institutional data. SCHY isn't replacing SCHD. It's completing it. The investors who figured this out months ago are sitting on portfolios that worked in 2025, no matter which market dominated. Let me show you why SCHD lovers absolutely need SCHY right now. The uncomfortable truth about SCHD in 2025. Let's talk about what everyone's whispering. SCHD delivered roughly 0.3% year-to-date through October 2025. Meanwhile, SCHY, the Schwab International Dividend Equity ETF, returned approximately 22 to 24% in the same period. That's not a small gap. That's a canyon. But here's the thing most investors are completely missing. This isn't SCHD's failure. It's proof you need both funds. SCHD's methodology hasn't changed. Its quality screening is identical. The problem? It's 100% concentrated in U.S. dividend stocks that happen to underperform in 2025. When U.S. value stocks, healthcare, and energy get crushed while international markets surge, SCHD holders feel every bit of that pain. That's not a SCHD problem. That's a diversification problem. What exactly is SCHY? Think of SCHY as SCHD's international cousin. Same family, same rigorous standards, different geography. Here's what makes SCHY special. Tracks the Dow Jones International Dividend 100 Index with 132 holdings from developed and emerging markets, all outside the United States. Requires the same 10-plus year consecutive dividend payment history that made SCHD legendary. Screens for financial strength and lower volatility using identical quality methodology. Expense ratio is just 0.08%, only 2 basis points higher than SCHD's rock bottom 0.06%. The key difference? SCHY gives you access to quality dividend aristocrats in Europe, Asia, and Australia that SCHD completely ignores. Companies like GSK, 4.33%, Roche, that's 4.19%, Enel, 4.12%, Vinci, 4.05%, and West Farmers, 4.06%, global dividend champions. The three problems SCHD only holders face. Problem number one, I'm 100% concentrated in U.S. dividend stocks. Here's the brutal reality. If you only own SCHD, you have zero international dividend exposure. When U.S. value stocks underperform like they did in 2025, your entire dividend portfolio suffers. You're betting everything on one country's market continuing to dominate forever. That worked great from 2011 to 2024, but 2025 proved that bet has risks. Your three-part solution. Solution A, start small. Add SCHY at 20 to 25% of your dividend allocation. This gives you international diversification without abandoning SCHD's proven long-term track record. Solution B, the balanced approach. Split 60% SCHD, 40% SCHY. You keep SCHD as the core because its 10-plus year track record is still phenomenal, but you capture international opportunities when they outperform. Solution C, equal weight strategy. Go 50-50 SCHD and SCHY if you truly believe in global diversification and you want maximum geographic balance. Here's what's crazy. The smart money already figured this out. SCHY pulled in nearly $500 million in net flows over the past year. Institutions are adding international exposure, not replacing U.S. holdings. Problem number two, I'm missing international dividend growth entirely. Some of the world's best dividend growers aren't in the S&P 500. They are in European utilities, Asian conglomerates, and Australian resource companies. SCHY's current yield sits at around 3.60 to 3.70%, slightly lower than SCHD's 3.85%, but still solid. The real story is the growth potential from international markets at different economic cycle stages. 3 ways to capture this. Strategy A, the income optimizer. Use SCHD, 3.85% yield for your highest current income, and SCHY 3.70% yield for geographic diversification. Combined yield is approximately 3.80% with true global exposure. Strategy B, the currency play. SCHY gives you currency diversification. When the dollar weakens, your international holdings can surge. Exactly what happened in 2025. Strategy C, the valuation opportunity. International dividend stocks often trade at lower valuations than US stocks. You're buying the same quality screening cheaper. Problem number 3, all my eggs are in the US basket during a tough year. Let's be honest, SCHD has been one of the worst performing dividend ETFs in 2025. That's not because it's a bad fund. It's because US value stocks, healthcare, and energy got hammered while tech dominated. SCHY provides the insurance policy your SCHD holdings desperately needed this year. When US value underperforms, international markets often pick up the slack. 3 allocation strategies based on your conviction. Conservative US focus, 75% SCHD, 25% SCHY. Keep America as your core with international insurance. Total yield is around 3.80% with geographic protection against US-only risk. Balanced global approach, 60% SCHD, 40% SCHY. True diversification between US and international dividend quality. Total yield of around 3.75% with balanced global exposure. Aggressive international tilt, 50% SCHD, 50% SCHY. Maximize international opportunity. Total yield around 3.70% with maximum diversification benefits. The data that tells the real story. Here are the numbers institutional investors are watching in October 2025. Statistic number 1, SCHY's 22 to 24% year-to-date return versus SCHD's 0.3% shows exactly why geographic diversification matters, especially in years when US value underperforms. Statistic number 2, both funds require 10 plus years of consecutive dividend payments. You're getting the exact same quality screening internationally that made you love SCHD domestically. Statistic number 3, SCHY holds 132 international dividend growers, while SCHD holds 103 U.S. dividend growers. Together, that's 235 quality companies across the globe. Statistic number 4, the expense ratio difference is only 0.02%. SCHY at 0.08% versus SCHD at 0.06%. That's just $2 annually per $10,000 invested. Practically nothing. Statistic number 5, SCHY's top holdings include verified dividend aristocrats. GSK at 4.33%, Roche at 4.19%, Enel at 4.12%, Vinci at 4.05%, and Wesfarmers at 4.06%. Companies you can't access through SCHD. Statistic number 6, SCHY's 3-year annualized return of 13 to 17% proves this isn't a one-year fluke. International dividend quality delivers over time. Statistic number 7, together SCHD plus SCHY give you dividend exposure across dozens of countries. True global dividend diversification from just 2 ultra-low-cost funds. Statistic number 8, both funds use the same Dow Jones methodology, focusing on quality, sustainability, and fundamental strength. SCHY is literally SCHD's international counterpart. The honest reality check. Here's what you need to understand. SCHY isn't better than SCHD. They serve different purposes and shine in different market conditions. SCHD wins when U.S. value stocks outperform, the dollar strengthens, and American dividend growers dominate. And you want the absolute lowest fees possible. That's 0.06%. SCHY wins when international markets outperform, like in 2025. The dollar weakens, global dividend stocks get revalued higher, and geographic diversification pays off. The smarter play? Own both. Let them work together. When one zigs, the other zags. Your portfolio wins either way. Your step-by-step implementation plan. Week 1, assess your current position. Calculate how much of your portfolio is in SCHD. Be honest. Are you comfortable with 100% US dividend exposure after seeing 2025's performance? Determine your risk tolerance for adding international stocks. Month 1, start building your SCHY position. Don't sell any SCHD. That would be a mistake. SCHD's long-term track record of 12% plus annually since inception is still phenomenal. Use new money to add SCHY at your target allocation. Start with 20 to 25% if cautious, up to 50% if you want maximum diversification. Enable dividend reinvestment on both funds. Month 3, rebalance and optimize. Review your SCHD, SCHY split. Rebalance only if either position drifts more than 10% from your target allocation. Consider dollar cost averaging into SCHY monthly to smooth out volatility. The bold truth. SCHD is still phenomenal for long-term investors. Don't let one tough year make you abandon a fund with a 12% plus annualized return since 2011. But SCHY gives SCHD what it desperately is missing: international exposure, currency diversification, and access to global dividend aristocrats that can outperform when U.S. markets struggle. Start today. Keep your SCHD position. It's your foundation. Add SCHY at 20 to 50% of your dividend allocation for true global diversification. Reinvest dividends from both. Let geographic balance work for you. The investors who love SCHD but refuse to add SCHY are making the same mistake as those who stayed 100% US stocks and missed international opportunities throughout history. Don't make that mistake. Love SCHD for what it is. Add SCHY for what it offers. Build a complete, globally diversified dividend portfolio that works in any market environment. This is educational content only, not financial advice. Consult a financial advisor before making investment decisions. Past performance doesn't guarantee future results. SCHD remains legendary for long-term dividend growth. SCHY is its essential international partner. Together, they create the most complete, globally diversified dividend strategy on the planet. 2 funds, global dividends, 1 unstoppable portfolio. Please like, share, and subscribe. Here's to your investing success and profitable investing.